Okay. Are we ready?
We are.
Can you hear me? Do I need to do anything?
Is the mic on?
I didn't do anything here. Oh, she's putting it on. Okay.
Okay. I think that.
Okay. Thank you.
You're on.
Sorry?
You're on.
Okay. Thank you. Now, let's go back to our little chart here and see where we are. We started with the Asian and Middle East country increased foreign exchange holding and invest in the U.S. Drove the interest down. We have the high-tech bubble, the Fed low interest rate, and we have the prime and subprime mortgage issued. All right, and then we talk about CDO. Is that right? We know what's a CDO. Is that right? Prime mortgage sold to Fannie Mae, Freddie Mac. Investor buy, sell 50 to 60 trillion in credit default swaps. Trillions. In credit default swap, we know what a default swap is, all right? Okay, these mortgage and other security were sold to investor worldwide. Small school in the Wall Street Journal, on one of the business journal, were featuring one small town in Sweden where they bought the stuff. Okay, well, you see some of the problem there, no regulation or many mortgage originator. We talked about that. Problem too high rating, we saw that. And then the problem with CDS backed by other CDS, not capital. Sometime also, you know, they don't have to put a collateral, they put other CDS. Okay, now we were at the fall of risky debt. Housing bust began late 2006, sorry. Interest rate rise. AAA rating downgrade on subprime and CDO. CDO carry and disclose and enterprise risk. We talked about that a little bit. And credit default swap have insufficient capital to cover the loans, and the default rise. We went all over this. Is that right? Okay. Now look at what's happened. All these little bombs there. It's 100 billion.
Yes.
Is that right?
Yes.
100 billion bailout to Freddie Mac and Fannie Mae. Lehman Brothers bankrupt. Washington Mutual rescued by JP Morgan. Merrill Lynch sold to Bank of America. And then the whole thing started. Okay? That's basically the crisis in here. This is the impact overseas. This is the Dow Jones Euro Stocks Index, which has 50 blue chip kind of stock in Europe. And you can see they have the same thing. Stock market was going up, and all of a sudden, the whole thing went down. A process of deleveraging started. Deleveraging means paying debt. Leveraging means borrowing money. Deleveraging started. Between 2002 and 2006, household borrowing annual growth rate was 11%. A financial institution borrow annual growth rate 10%. Now that's not sustainable. If you are borrowing that much every year, that's not sustainable. These banks have to write down and sell distressed assets. The problem is, what's the price to put on a distressed asset? See, that's a big issue, a lack of buyer. They have to pay off the loan, and also they are required to increase capital. Who's going to buy a stock in a bank during that period? That's how you raise capital sometime, or borrow money. And now, this is the Federal Reserve Bank does a survey asking the bank lending senior loan officer, are they tightening standard or not? Standard means if you apply for the loan, are they asking more documentation? Are they making it harder for you to get the loan? As you can see here, in 2006, it started tightening the standards. This is the dotted line for a small firm, and the other line is for the large. So you can see here, they start tightening credit here. People going there want to borrow money? No. And that's what's really drive the economy down. And then they start easing in 2009, 2010. This is net percentage of domestic responded tightening standard to commercial real estate. As you can see also, they started doing it here, and that's also an indication that the market. Now, the summary of the cost, this is an IMF paper that just came out in June, and where people are looking at the cost of the crisis. the cost of the crisis. And they are comparing this to the crisis before, and they divide it in three parts. Direct fiscal costs, that means what the taxpayer are paying, increase in the public debt, and output loss. Output loss means production. As you can see, this, in advanced economy like the US and Britain, etc., the direct fiscal cost is a lot higher this time, 5.9% of GDP. Before, in the earlier crisis, about 3.7. Okay, direct cost of that. And output loss is not that high, but you can see in other economy, it's different. For example, in emerging market, the output loss was greater during the other one because their crisis wasn't really financial. This crisis was mostly trade. The government response was on a fiscal policy level, where the government basically have these huge programs that they are financing $700 to $800 billion, and that's deficit. There are three ways these things go. It can be reduction in tax, it can be infrastructure that the government is paying for, and then you have the monetary policy. It can be the interest rate, which is already low, or it can be change in the balance sheet of the Fed. Balance sheet of the Fed means the Fed now, look at the balance sheet of the Fed. It went this all the way there because they have to inject liquidity in the system by buying assets, by loaning money, and their balance sheets really have changed a lot. And that's worries some people today because they can see inflation down the road because the government is borrowing too much and because the Fed is doing this. I'm just going to show you quickly what's inflation. A lot of people said, hey, why is the worry about inflation? I'm going to show you an example here. I wonder if we have, can ask them if we have sound here or not. We'll find out. Is that right? Okay.
Is there screaming involved in this?
No.
Just crying.
Moaning. I'm just going to show you. Just show you the impact of inflation. People sometimes say, why are the Federal Reserve, all these people worrying about inflation? Can we?
There is no audio.
No audio. Let me see. We can make it. There is no audio here.
No.
Okay, that's good. I'm just going to show you. In this video, if you go to it, you will see that they change the price every hour. Imagine all the people at Kroger running around, putting 30 after tomatoes. You know, every pound of tomatoes now it costs 100 million. That's why really the inflation, the loss of the purchasing power of a currency is a very important concept, and that's why people talk a lot about it. Now, what is the impact of this globally? As I said, the shock in the US and the shocks in Europe were mostly financial. Financial means stock market went down, credit market froze. In Asia and different places, it was mostly output. That's mean export. Their export went down. And you can see they have a slightly different angle on this. And the fact also that interest rate went way down here have an impact on the dollar, the value of the dollars. Let me show you what the dollar is doing and why people are concerned today about it. Okay. Let me see. We're going to see a dollar here. D for dollars, all right? No, that's not it. I'm trying to look. There is a dollar weighted thing. Huh? No, that's the PowerPoint. That's Now euro stock, okay, let me see, there should be a dollar sign somewhere. It's a dollar weighted foreclosure. Okay, let's do a type. And it should be okay, it's not there. Euro crisis. Surprised I don't have a dollar here. $5. I don't see it here, but the dollar has been going down, and people are worried about the impact that may have on the economy. Now, when the dollar go down, what is the impact of that? Your export will be what? Will go higher. Is that right? Now, that's why a lot of people are saying today that China should increase the value of its currency, because its currency is undervalued. They need to increase the value of their currency because it's very cheap. That's why they can export a lot. And today, the IMF, they had just a meeting to ask, everybody is trying to get out of the recession by lowering their currency. That's why they can export. Is that right? But if everybody's doing it, then we're going to have a problem. Is that right? The Brazilian and the Chinese are saying, well, the problem is here because your interest rate is too low, you are flooding the market with money. The Federal Reserve probably in November going to do the same. And the Americans are saying, no, it's because of you guys have a currency that should be a lot stronger. And that's part of the debate today of what to do with these imbalances. And the imbalances, some of the roots come from some of these countries have high saving rates, low investment opportunity, okay? And some have the opposite. But that's one of the issues that's going around today. In the country today also the issue of foreclosure, where some banks are stopping the process because lack of document. That's another issue that is today, and that is going to be bad for the market. Yes?
Something I'm curious about is if all these mortgages have been sliced and diced and sold to various people,
Yeah.
who originates the foreclosure then? Foreclose on a mortgage when no one knows for sure?
No, whoever has, for example, if that SPV, the bank owns those SPV, those special purpose vehicle places, they are the one who own the mortgage, okay? They are the one who bought it and sold it and they sell interest on it, but they are the one who own it, basically the banks, okay? The banks are the one who own it and they are the one who are going to foreclose on I have statistics here on the different banks and which one of them, how many of them this month, and that should be an Excel spreadsheet. Okay. I don't know, let me see if I can make this bigger. This is as of this week. LaSalle Bank, you see they divide them in 30 days, 90 days, and how many of these, but these are the banks that really hold these loans, and you can see here some of them really have a lot of delinquency going on, okay? But all the banks are affected by this. The question is, what's happened if you stop that process? What's happened if you stop that process? You're going to dry up. All these CDO are going to have to, people are not going to buy them. And that's probably going to create a big problem in the marketplace. That liquidity problem is going to start again if we don't find a solution to this, because the people who couldn't pay, if we foreclose on them, that's the money going to go to the investor. If no money is going to the investor, investors are not willing to buy these CDOs anymore. They're going to stay away from the market. Does that make sense? Because you see, let's say if they foreclose, I will get 70 cents on the dollars or 40 cents on the dollar. That's better than nothing. But there is no foreclosure. I'm not getting anything because the people walk out of the things and I'm just left holding the bag, and that's maybe a bad idea to stop the process. Let's open. Yes.
My own personal opinion is that at some point they will have to repeal or undo the grain leach legislation and try to unbundle banking, investing, the risk and reward of those businesses that they put all together and deregulated. Don't you think the pendulum is going to swing back the other way? Then we'll have liquidity and confidence again?
The problem is you may kill innovation in the process. You may, if you start doing a lot of that, and it's true, that's what some people are saying today, let's go the other way around. But you see, you will not have access to capital market as the average person. You see what's happening in the 1980s is Wall Street meeting, middle class, okay? Before, Wall Street was for the high end, but because of all these mortgages and all this stuff, Wall Street become more accessible to the, if you go too far, you're probably going to kill innovation. You must have it. Today, there is no more an investment bank in the country. All the investment banks are gone because they chose to be FDIC regulated, and all of them are gone. And that may have an impact on innovation. That may have impact on initial public offering in the futures and investment in general. Now, there must be some regulation because we saw that the lack of it some time ago, but I don't know how. Yes?
Yeah, given the results of the innovation.
Are you talking innovation as an accredited function?
No. I'm talking about innovation in terms of, capital. I'm talking about creating the next internet or creating the next, big product stuff. That's what I'm not talking about. That you can always blame the finance professors for this stuff here, because I was telling somebody earlier, one of the finance professors said yesterday that we should sue the Nobel Committee because they gave this Nobel Prize to these economists that created all the derivatives. Yes, but somebody also earlier mentioned that the politician play a role in this by saying that everybody should have a house, and it's partly, but everybody has a share in this. The people who borrowed money, the bank, the broker, the government, everybody has a share. While the party was going, everybody was happy. When the party ended, everybody's trying to say, no, it is not my turn. This is the dollar thing I was showing you. This is the US dollar weighted rate. That's meanwhile weighting it by the export. As you can see here, the dollar was way high, went up, and now the dollar is very low. Okay, and that's other countries are saying, well, Brazil, for example, the Minister of Finance is saying, well, you are flooding our country with your money. People are coming because low yield, okay, and that's going to have an impact on them. They're trying to restrict this. So some country like Thailand is trying to put a tax on money that is coming in, okay, and that's another way. People are looking for yield, looking for a rate of return, and they are not getting it here. They're going to go somewhere else, and when they go somewhere else, if they go to Brazil with their money, they're going to buy the Brazilian currency. That will increase the value of that currency, and they don't want their currency to go up because it's going to depress their export. Does that make sense? Yeah. Okay. They don't want that hot money. That's called hot money coming in, because that hot money is going to start increasing the value of their currency, and if their value of the currency go up, they can't export. Brazil is one of the largest exporter of playing. If you have, and they don't want this to happen to them because it's going to make their product more expensive to sell overseas. Okay, a lot of countries are trying to get out of this by using the export, and you can't use the export engine with a strong currency.
So the Fed's going to make this worse because they're going to start another round of this stuff.
That's,
and so where do you see this all going?
well,
say a year, 2 years?
I don't have a prediction. I just say that if they put in more money, with interest rates already at 0%, I mean, the Fed is already at 0%. If they put in more money, there is likelihood that we'll have inflation in the future. And inflation in the future, that's just past experience. Now, we may have an economic boom a year from now, and the tax receipts start coming in, the deficit go down, and anything can happen. But in general, when you have that type of liquidity in the system, and we have the fiscal imbalance that you have, you are likely to have inflation down the road, and inflation is not good for the country. But I can't tell what's going to happen. A lot of people said something going to happen in November, election going to change the course, and the tax overhang that is on the economy now. What's going to happen with the Bush tax? Are they going to expire? Are they going to have them? That will have an impact on some of the financial market. All these are issues that's going to be resolved shortly. And I can't tell who's going to win and who's going to lose. There is a place I some time ago to that is very good at predicting those things, and it's called Intrade.com. Intrade.com. Yes. This is a place where people bet real money. They are buying a future contract on event, like who's going to win. For now, look like the contract for Republican taking control is 84. And there's a lot of sophisticated people playing this game, and it's very good. It's accurately. Last year a couple of years ago for the presidential election. It's very, very good because there's a lot of money riding on this, and you can buy a contract. There is 84% chance, basically, according to this, that the Republican gonna win. That's mean you buy the contract at 84. If they win, you get 100. Now there are other issues here. There is only 66 gaining the Senate. There's all kind of things here you can bet on. I'm not saying go ahead and gamble with your money, but I'm just saying, these places people are putting money, and usually it's well informed. So it's called Intrade.com, and they sometimes have it on BP going bankrupt, and people start the contract, and you can see it going down and doing it. But I really have no idea where the election is going to go. Yes?
In the book
Yeah.
the chapter on this in the book,
Yeah.
and they talk about the Glass-Steagall Act that was passed after the Depression.
That's right.
And that, I guess, served as somewhat of a firewall against a lot of the shenanigans that led to our current. Is there any thought of
That is right.
going back to get that again?
Well, the bank in the past where they have a deposit, they can loan those deposits. Now the bank when you go to a bank, you have an investment advisor there that can sell you insurance product and can do all kind of things. And that's what's happened. It's not just with the 1999 Act. Before that, they started these deregulation things over time. It's not really any administration to blame, even though it's Clinton who signed the 1990 Act. Now people are saying let's just go back. Well, so far there's no investment bank anymore because they wanted FDIC protection. They want the protection. They can do some of this stuff. The ratios, for example, leverage. The leverage was 15-1 in banks, but Lehman Brothers has a high number. I don't remember exactly, but it was a very, very high number. How much risk they are taking based on the capital they have. How much loan they are making based on the capital they have. And some people are saying today, let's go back to that old days. Now, can we have a housing boom? Can we have an internet boom with those rules? Can we finance a new enterprise? Can we finance the next Google if they go to a local bank that has only a few $100s in deposit? I don't know. Yes?
After limiting the credit default swap, so it's the people who have an interest in what's being involved rather than all these side bets
He's saying, why don't we just limit the, his question is, why don't we limit the credit default swap to the people who are really have an interest in it? Like, for example, the bank with hedging. Take out the
There were a lot of people that were involved in the CDSs they were fundamentally gamblers.
Nope, yeah. They were investors. That's what they call themselves. You see, if you look, for example, at the future market or any of these markets that are derivatives, it is the speculators that provide that liquidity.
Yes.
It's very important to have these people there. I'm not saying we should not put restriction on what they do. But if you just take the corn future contract, if it wasn't for all these speculators, it will be very small. There will be no liquidity in it. And it's important that these people be allowed to be part of it. You can put some restriction on their behavior, but disallowing the whole thing may have detrimental impact on it. But I agree with you, there is a lot of things going on there where people are buying this protection on something they have no business in doing it, but it's easy providing liquidity. If you buy a future contract on corn and you are a speculator, you have no business in corn, but you're really providing that liquidity in the market that is very important for the farmer and for Kellogg or whoever is hedging theirs. So here's some questions. You guys have some? Yes.
Early on today, you said that you'd give us a website.
Oh, yes. Let me see if I'm just going to check my email quickly to make sure I got that on. And, okay, it looked like they put it under, let me see if it's on already. It's www.right.edu, and this is business. ACAD. I will make it bigger for you in a minute when we know it's working. Okay, and what did they say here? They said, okay, please make sure, okay. Oh, here it is, okay. Okay, they put it on. Let me then do this and make it bigger. Control C, and I'll put it here for you on, let's see, they have Word here. They have Word document here, okay, good. And then Control V, and let me make this bigger. Can you see it? Yes. Okay. Now, if you go to this www.right.edu, because people in the back there may be too far for them, business, ACAD, that's probably academia for finance, and it said global underlying financial crisis. And I'll go over this in a minute. We're going to click on it to make sure it's there. Okay. This will have all the papers, all the places that if you want to learn more about it, okay? Finance global financial crisis.html, okay? And when you go there, you can just download the file yourself. That way you don't have to go to Wright State all the time. You can just download that file and do it. Now let's quickly go over it. Did you guys have it? Okay, this is what it is, and you can see here it has the different websites. Now I gave you also different opinion. For example, these people at the American Enterprise Institute have a different opinion. They think it's all because of the government, okay? Okay, the whole thing is the government. I mean, I give you different opinion there, depending if you watch Fox or CNBC. I just gave you, I gave you the different opinion. Yes, I mean, they're all here. I mean, the different type here. And I gave you few, this is the Council on Foreign Relations. They have a video there. This is the Federal Reserve Bank. This is Nobel Prize economist Paul Krugman on the other side. And I gave you, some of the books are here. And the IMF has a good website there. And the world in crisis. And there are a lot of places here. What is the impact? What's the different things? And it's kind of bibliography, more or less, on the topic. And this is good. This is just, they haven't finished their work yet, but this financial crisis inquiry commission, they have to give the report to the president by December 9, I believe. But there are a lot of people there, and there is a lot of document. If you want to know what the CDO is, or what the CDS is, or this, they have simple explanation there where they explain the whole process. And again, this is just a different way of moving. This is selected. If you look here, these are some of the things I was talking about. This is what is the financial service and the insurance as a percentage of GDP. This is the LIBOR we were talking about. Remember when the LIBOR went way up? The LIBOR was the index we were using to see if your mortgage payment is going to go up. If you had a subprime loan, remember that? It just went way up there. As you can see, it went way up. And that's why some of these people couldn't pay. There are a lot of information in some of these. This is the SP 500 I showed you in different corporate profits.
How often is this updated?
This is actually is not going to be updated because they have to, this is part of the report. They are writing to the president by December, and I think by December that will be it. I don't think they will have anything, but I'm not sure. But this has all the information and it's current. Now, any question? I have a lot of slides because I didn't know how long will this last. And if you have any question on a specific topic, I can go ahead and yes.
Paul, if I could ask you to talk just briefly about the international efforts.
Okay.
To provide more regulation and so on.
Okay.
To protect against future crises, because from a political standpoint, the big shift is from the G8 to the G20. A much larger group trying to come up with possibilities, and then others through the Bank of International Settlements and so on.
Sure.
Could just talk a little bit about some of the things that are being attempted to prevent this from happening in the future.
Okay. Very, very difficult question. On the technical side, the Bank of International Settlements is trying to put some rules that supposedly we're all going to abide by, especially the banks, okay, to make sure that the risk, people take risk have to put capital on the side, okay? If the bank want to loan more money, they should have more capital in their balance sheet, and et cetera. And there is a shift because you see, in the globalization part, each country or each group of country kind of specialize in something. And the Chinese specialize in exporting goods and services. Most of Asia, I think people here specialize in money or finance, okay? And this has to change over time. This distribution of work where some people produce and the other one kind of consume have to somehow change. And I don't know how well that's what this discussion at the IMF now, where people are talking how we're going to resolve the issue of the currencies, these imbalances in the currencies, where some people think the dollar is too low and some people want the dollar low here because they really want to get out of recession through export. And those are some of the issue that's the international, the G20 And there is this emerging power, the BRICS, Brazil, Russia, India, and China also, which want to have a bigger stake in the whole thing, and the bigger country, industrialized country, resisting it in terms of their share in the economic model and who make the decision. Okay, and this is also the same going on in the political sides at the UN, where some of them want to be in the Security Council, and there is a lot of things that is going on because of this crisis, and some of the country also pegging their currency to the dollars going to be an issue, or pricing their product, like the oil country pricing their product in the dollars. And the dollar is going down, they are not getting enough of it. If they move out of that, what is the impact of that? Those are some of issues that's really the international community is trying to figure out who's going to pay the price, because there must be a price to be paid. This is a reserve country, currency, I mean, the dollar is a reserve currency. Will it keep to be a reserve currency? Will the euro become a reserve country? Will the Chinese revalue their currency as everybody else is asking them to do? They have started a little bit by almost 2%, 3% now, but people are asking for more. Can China shift from export-led economy to a domestic-driven economy, like here? Okay, those are some of the issues that's probably going to take time to resolve. But the most important part now is to make sure that we don't have a liquidity crisis or a confidence crisis, and then we move forward. I think those are some of the issue that's. Any other question?